Since March 30th, the S&P 500 has rallied by 16%. But here is the part that should make every dividend investor stop and think. Just 10 stocks drove 69% of that entire rally. Nvidia, Google, Amazon, Broadcom. A handful of AI-connected names doing almost all of the heavy lifting while large parts of the market barely moved. And here is what that means for you, specifically if you are building a dividend portfolio. The purchasing power of $1 from the year 2000 has collapsed by 50%. $1 in the year 2000 now buys what 50 cents bought in 2025. If your dividends are not growing, if the income you receive this year is the same as the income you received 5 years ago, you are quietly falling behind inflation every single month without even realizing it. The solution is not complicated. You buy stocks that consistently grow their dividends. You build a portfolio where the income increases every year so that your purchasing power does not quietly erode while you sleep. In this video, I'm covering 5 stocks that just recently announced dividend increases, what those increases mean, whether the fundamentals actually support them, and what the honest risk picture looks like for each one. Let us get into it. The first stock is NASDAQ Inc., and they just announced a dividend increase of 15%. That number alone deserves attention. A 15% dividend increase is significantly above average. The 10-year dividend growth rate for NASDAQ sits above 10%, and the 5-year rate is close to 9%. So this most recent increase was not only strong, it was above their own historical trend. Now, the most important question with any dividend increase is whether the underlying business can actually sustain it. A company can raise its dividend once. What matters is whether it can keep raising it. For NASDAQ, the answer looks compelling. Free cash flow growth over the past 5 and 10 years has run at around 13 to 14% annually. The free cash flow payout ratio sits at only 30.2%, meaning even after paying dividends, the company retains significant cash to reinvest and grow. Revenue has expanded from around $6 billion in 2023 to approximately $8.2 billion in 2025, and profit margins have expanded dramatically, from 37.9% in 2021 to 47.9% last year. There's also a structural story worth understanding here. NASDAQ is transforming from a more cyclical exchange operator into a recurring revenue business. Their annualized recurring revenues grew 12% year over year, the kind of predictable cash flow profile that commands premium valuations and supports long-term dividend growth. The starting yield is low at around 1.2%. This is not an income stock today. But for dividend growth investors building for the future, a 15% raise backed by 13 to 14% free cash flow growth is exactly the kind of combination worth paying attention to. Wall Street's average price target is $108, implying around 16.5% upside. My dividend discount model at 7.5% forward dividend growth implies fair value closer to $113, around 22% upside from current levels. The second stock is Apple, and the dividend increase was only 3.8%. Before you move on from that number, let me give you the context that actually matters. Apple does not primarily reward shareholders through dividends. It does it through buybacks, and the $100 billion buyback program they just announced alongside this dividend increase is the real story here. Here is why buybacks matter for dividend investors specifically. Apple has reduced its share count from over 23 billion shares in 2015 to less than 15 billion by the end of 2025. That is a 35% reduction in shares outstanding. When the number of shares shrinks, every per-share metric improves, even if total revenue stays flat. Here is a concrete example. Apple's total revenue actually declined slightly from $394 billion in 2022 to $391 billion in 2024. But revenue per share jumped from $24.32 to $25.48 over that same period, because there were simply fewer shares to divide the revenue among. This is what shareholder yield means in practice. When you combine Apple's 0.35% dividend yield with an approximate 3% buyback yield, total shareholder yield is around 3.35%. Add projected EPS growth of around 9.6%, and you get expected returns in the 12 to 13% range, before accounting for any multiple expansion or contraction. And that multiple question is the key risk. Apple is currently trading at a PE of around 35. a premium relative to peers and above its own historical average. Boy, if that multiple contracts even modestly over the next 5 years, it offsets a meaningful portion of those projected returns. Pooh. This is a stock I own and have done very well from, but at current valuations I am not adding PO. Wall Street's average price target implies only around 7% upside, which tells you even the bulls think most of the easy gains are behind it at these prices. PO. The third stock is Paychex, and they just announced a 10.2% dividend increase PO. On paper, the dividend metrics here look outstanding. The trailing yield is now above 5%. The 5-year dividend growth rate is 11.25%. PO. A 5% starting yield combined with double-digit dividend growth is the kind of setup dividend investors dream about. PO. But the stock is down 40% over the last year and down nearly 16% year to date, and the reason is one word. PO. Artificial intelligence. This is the single biggest threat to the business model for companies like Paychex.po. Paychex is one of the largest payroll and HR management companies serving small and mid-sized businesses. TTPO. It has SaaS-like characteristics, recurring revenue, high retention, subscription-style pricing, which is exactly why it historically traded at a premium PE of around 27.5 PO. But the market is now asking a different question. What happens to payroll and HR software when AI can automate significant portions of what these platforms do? PO. That uncertainty has caused the forward PE to collapse from 27.5 to 16.7. A 40% compression in the valuation multiple PO. The near-term earnings picture is actually strong, but analyst earnings estimates drop significantly by 2027 and 2028 because the market genuinely does not know how AI disruption will affect the business model in that window. PO. This is not a straightforward valuation call. The dividend metrics are attractive, the current business is healthy, but the longer-term cash flow trajectory is genuinely uncertain in a way it was not 3 years ago. PO. The risk profile here is meaningfully higher than the headline yield suggests. PO. The fourth stock is FactSet Research Systems, and they announced a 5.5% dividend increase. PO. The context around that increase tells the real story. This stock is down 52% in the last year, down 23% year to date, and yet they are still raising the dividend. What does that mean? PO. FactSet provides financial data, portfolio analytics, company fundamentals, risk tools, and wealth management software to investment professionals. PO. Think of it as a competitor to S&P Global, Morningstar, and MSCI. The business generates consistent recurring subscription revenue from institutional clients who are deeply embedded in their systems. PO. The threat is the same as Paychex. AI. If AI tools can summarize filings, build financial models, search databases, and answer research questions faster and cheaper, financial firms may not need as many expensive FactSet seats. PO. But here is the counter-argument worth considering. PO. The forward PE now sits at only 12, pricing the stock as if earnings growth is essentially dead. The 5-year historical average PE was around 27, a 55% compression in valuation. PO. And FactSet has been actively expanding its AI capabilities, including rolling out AI-enabled document search to over 85,000 users powered by its own premium proprietary data. PO. That last point matters. Building AI on top of clean, trusted proprietary financial data is a genuine competitive advantage, one that generic AI tools built on public internet data cannot easily replicate. PO. Even if we assume the PE multiple stays exactly where it is today and the company achieves just 10% EPS growth, the forward returns remain in the double-digit range, plus a 2% starting yield. PO. Wall Street's price target of $246 implies only about 10% upside, but that feels conservative given the degree of the sell-off relative to the business model durability. PO. This is a higher risk situation, but a 52% decline in a business with premium proprietary data and institutional client stickiness is worth examining carefully before dismissing. PO. The fifth stock is Chesapeake Utilities, and they announced a 7.3% dividend increase. PO. This one is very different from the previous two. No AI disruption risk, no valuation multiple collapse. Just a steady, boring, reliable utility business doing exactly what steady, boring, reliable utility businesses are supposed to do. PO. The dividend yield sits above 2%, and the 7.3% increase is right in line with their historical growth trajectory, which runs at around 6 to 7% annually across both the 5 and 10-year timeframes. PO. One thing worth addressing up front, Chesapeake shows a negative free cash flow payout ratio. which on the surface can look alarming, but for utility companies, this is completely normal and not a red flag. PO. Utilities have extremely high capital expenditures by nature. They are constantly investing in infrastructure, pipelines, and distribution systems. PO. For these businesses, the earnings payout ratio is the more appropriate metric for judging dividend sustainability, and on that basis, Chesapeake is targeting a 45 to 50% payout ratio, a healthy and sustainable level that leaves significant capital for reinvestment. PO. The valuation is also reasonable. A dividend discount model assuming 6.5% forward dividend growth implies around 13% upside, very close to Wall Street's average price target of $144.67, which implies 14% upside. Top where you PO. Chesapeake is not exciting. It is not going to double your money in a year, but it is the kind of consistent compounding utility that belongs in a diversified dividend portfolio. Steady income, predictable growth, and a management team that has explicitly committed to their dividend growth targets in writing. PO. 5 stocks, 5 very different situations. PO. NASDAQ is a dividend growth story backed by genuinely strong fundamentals and an accelerating recurring revenue business. Low starting yield but high growth potential. PO. Apple is a shareholder yield story where buybacks do most of the heavy lifting. Quality business, but the valuation premium leaves limited upside at current prices. PO. Paychex has the most attractive headline dividend metrics, 5% yield, double-digit growth, but carries real uncertainty about what the business looks like in 3 to 5 years as AI reshapes HR software. PO. That last point matters. Building AI on top of clean, trusted, proprietary financial data is a genuine competitive advantage, one that generic AI tools built on public internet data cannot easily replicate. PO. Chesapeake Utilities is the quiet, reliable compounder, boring by design, predictable by nature, exactly the kind of stock that belongs in the foundation of a long-term dividend portfolio. PO. Here is the broader lesson from all 5 of these. Dividend growth investing is not just about finding the highest yield. It is about finding businesses whose cash flows are durable enough to keep growing that dividend year after year, through economic cycles, through technological disruption, through whatever the next challenge turns out to be. The stocks that raise their dividends consistently over decades are not the ones chasing the most exciting business model. They are the ones building the most resilient one. That is what your portfolio should be built on. PO. If this breakdown gave you something useful, a clearer picture of any of these 5 names or a better framework for evaluating dividend increases, hit subscribe. More analysis like this every week. PO. And if you want to go deeper on building a dividend portfolio that grows your income every year, the next video is on your screen right now. Let us build something that lasts. PO.